I do too. What can I do? Good morning, everybody. Good morning, Kyle.
Good morning.
Hi. Welcome to Monday Morning Coffee with Kyle and Ann, everybody. I'm Ann Rossley here with my dear friend and colleague, Kyle Harvey. We sell real estate in downtown Chicago, and we love to dish on real estate. In fact, we were just kind of joking before coming on the air about some funny situations that we've been through, some of which we may share with you in a couple of weeks when we're able to talk about them, but not today. Today, we have lots of good stuff to talk about, don't we, Kyle?
We sure do. Interesting stuff. And stuff, I'm already going to take it away and talk to my building about it.
Oh, yeah, because today we're talking, folks, about condos. We'll do our quick stats in the beginning, but we're going to talk about assessments. Kyle and I get asked all the time about assessments. Are these assessments? And everybody always thinks assessments are too much, but we're going to dig into it a little today. But first, we're going to do stats, and stats are totally different this week. Last week, as in usually, we go through the lakefront communities and talk houses and how many sold last month and this and that. Today, we're taking the properties that have sold in the last 18 days since May 20th only. That's what all this is. Yep. So let's talk about it quickly. It's a little bit different. Let's see. Oh, I can do it. You know what? I just figured out I can make this bigger on my screen so my old eyes can read it. Let's see if it works. Okay. So this is what's happened since May 20th. 739 properties have closed. 966 are currently on the market. Okay. It's just a freeze.
Wow. Look at that. Yeah.
So I remember ages when you'd see the live listings and you'd have about a third of that number that's closed. You know what I'm saying? That would be like a typical market. But look at this. 56% of the properties that closed in the last 18 days were at or above listing price. 101.2% of sale list price to sales price is what I want to say. And the median market time was 8 days. Isn't that insane? And so
so when your buyer clients say to you, I want to get this for a steal, your response is,
nice. Yeah. And I want to think about it. That's the other thing. Let me think about it. You know, I have the sweetest client, first time buyer, and we went out to look, and he came back to me. We looked on like Saturday, and he came back to me on Monday and said, I'm interested in this one. Gone. And then he said, well, you know what? I think I'm interested in this one. Gone. So now he just went under contract this weekend, but he saw it yesterday and he wrote it yesterday. So
that's the way it's got to be right now.
The biggest band, although I don't know that this is statistically significant, is between 600 and 900,000. That's where they went the most over list price. 7 out of 10 went over list price.
I view those as sort of the trade up from the lower priced one. So this is your second home. And a lot of those properties are also for people who can't get a house, but it's big enough, because often those prices are 2+ bedrooms. So it's the second home, maybe not the forever home, but it's the downsize home.
Right.
Don't you think? So that would suggest why. A lot of demand.
True. Okay. Next. Okay. Here's the interesting part. You would think that the cheaper ones would go faster, right? But they're not. But you know what? I think part of it is because the cheaper ones, I think people are waiting longer to buy to where they have enough money to get a bigger, fancier place. What do you think?
I think,
because I don't see young people saying, oh, good, I'm going to go buy a studio.
No.
You know what I mean?
No.
I
think the studios now go to investors. because people will
Yeah,
still rent a studio, but I don't know that they'll buy it to live in. And I still think that people don't want to do work, and the cheap stuff needs work. So
yeah,
that's where I'm trying to go with you on this, that people are willing to pay for something in better condition that's a better product,
yeah.
regardless of size, etc. I'm guessing.
Agreed.
Okay.
Yeah. Okay. So this is what's currently on the market. But of those, 242 are under contract. So 25% of the inventory is AI right now. AI, folks, is in the contingency for attorney and inspection. AI. Okay. Today's acronym,
Wow.
AI. Okay. Now this cracks me up. Um, for what is closed, it was 8 days to contract. For what is currently pending is 12 days to contract. So if you want to laugh a little bit, you can say that the market's slowing a bit. So,
Well, but what's really interesting is this is not a perfect stat, because sometimes people take time to put things into the MLS and they
right.
accumulate more days than they
Yeah, but
really
that's
are.
the same on the left side too, though, wouldn't it?
But if you look at date of contract um, and then the chain, it's sometimes much shorter because they have to put the contract date in there.
Yeah.
And it doesn't necessarily reflect the date that
Mm,
they shifted it to AI. So listen, it's imperfect data.
absolutely. Yeah. Bottom line, if you're selling, you got to price fast. I mean, price it right. And if you don't get under contract quickly, that's a sure sign that something's wrong with your price, right? And if you're buying, you got to be ready to go. All right. So seller's market, strengths in the middle market, and we may be seeing it starting to ease. We'll have to see. That's where we
We'll have
are.
to see, because I do recognize that certain parts of the market will be strong throughout the summer because we have so little inventory and because there are so many people who still want to buy. I bet people will come back from vacation if good stuff comes on the market. So,
Yeah.
like that beautiful place that both of our buyers looked at this last week, I
Yeah.
think people would have come back from Wisconsin to see it or Michigan to see it, because, close by. I don't know that they'd fly back from Europe, but you know what I'm saying? That
I do.
I think there's going to
Necessity
be
and
a
yeah,
strong summer market because of the lack of inventory.
I think you're right.
We'll
Yeah.
see. We'll see.
All right. So one of the things we wanted to talk about today was condominiums and assessments. So I did a little, I had okay, what really got me into this was, okay, first of all, you and I, as we said earlier, we get questions about this all the time. People always say to us, I don't want to pay it high in assessments. I'd rather take this money and put it into a higher mortgage, yada, yada. And that's why there's so much interest in the walk-ups, right? The 3 or 6 unit buildings, because their assessments are lower. But here's the thing. What was the thing I was going to say? I forgot. What I was going to say. Senior moment. Remember when I had that unit at 6 North Michigan that was spectacular, and it didn't sell right away because the assessments were high. However, what really got me into this whole thought process was this. The assessments were high, but the unit wasn't that high on a price per square foot basis compared to other luxury properties. And if you looked at the assessment on a price per square foot basis, it wasn't so bad. Okay. I'll show you what I mean as we dig into this. All right. So I took for this study only condos, and I took out co-ops and I took out townhomes. I was very specific. Okay. So condos only in near north. And I also did high rises first, and then I compared it to all condos in near north that didn't have a doorman. So it's doorman versus no doorman and looking at prices. Okay.
Mhm.
So tell everybody what an assessment is, Kyle.
Um, so this slide actually makes it clear. It's what you're paying for each month to live in your building, and it covers the door staff, the common area heat, water, gas, and your heat, water, gas, but not your electricity. Insurance for the entire building, not your insurance, but the entire building's insurance. Scavenger, which is garbage, let's be honest. Exterior, etc. Any amenities. Some buildings charge a little bit for amenities, but most don't. And then capital reserves. Those are the typical components of a monthly assessment.
All right.
Oh, wow.
So
Yeah.
what does a doorman cost per square foot? And the answer is 90 cents a month, because you have brought this up in previous shows that the biggest cost in an assessment is the staffing.
And it's not just when we say labor, this is all labor. So these buildings don't just have a doorman, they also have an engineer and perhaps a maintenance staff. So I completely agree with this math when you consider the staffing is not just the doorman, but it's the staff. A walk up, you are the staff. In a condo building, there is a team, and this is the cost of the team.
Yes. So look at this, though. I thought this was fun. So if it's about 91 cents per square foot, okay, it's going to be 47 cents in a no doorman building.
So a lot of these no doorman buildings will have security, and they will have an engineer at least part-time. So there are some people, unless it's a walk-up. So some buildings, there are a bunch of buildings. I'm thinking of that new building, 56 West Huron, the one that popped up across from the, right there.
Mm-hmm.
That has security, a security system, but not a person.
Right.
And I think they have an engineer who comes in at least part-time to handle the garbage, the things like that. Right. So anyway, you still have stuff, but yes.
And not as much. Yeah.
Much.
This is a fun stat. So this breaks it down by bedrooms, and you can see the median assessment. So look at the 2-bedroom. A median price 2-bedroom in the near north neighborhood that has a doorman, you're going to expect to pay almost $1,200 a month.
At least.
That's a median number.
Really?
We run the numbers. That's the median. Yeah. So, but that includes buildings where you maybe they have efficient heat. I don't know.
So I think the difference is going to be the size of the building. So for example, you have to divide it amongst the number of units and whether a 2-bedroom is a big unit in the building or a small unit in the building. For example, the $1,200 for a 2-bedroom in a typical building. In a 400 unit building, that's totally right. But in a 100 unit building where 2 bedrooms are the big units, then that's probably not right. So it all depends on your percentage share of the ownership, which is a whole complicated math equation that we're not going to bore you with.
Right. Okay. So anyway, just expect that, everybody.
Absolutely.
And I'm going to break it down for you even more here. So here, look at 2 units that have the same assessment, $1,300 a month. One is a 1-bedroom, one is a 2-bedroom, 1,650 square feet. So $1,300 a month might be extravagant for a 1-bedroom based on price per square foot, but a real value for a 1,650 square foot 2-bedroom. You follow me on that?
I do.
So, that's another way to look at it. I found this fascinating. Older buildings do not expect a pricier assessment.
No.
It's the mids, the 50s and the 60s buildings that have the highest assessment based on assessment cost per square foot. Right? I know.
Again, Ann and I keep bringing you people back. It's the amount of humans that are part of your budget, because the doorman and the engineering staff have union contracts that are set. It's just a set fee, a set rate for where they are in their careers determines how much you pay for them. And you want people who are experienced. So, sometimes these older buildings have fewer staff than the newer buildings.
Right. Well, here's the other thing. If you're in a pre-war, your unit probably has space pack.
Mm-hmm.
So
that's air conditioning that is unit provided.
So you're paying for your own air conditioning, as opposed to heat and air being included in these 50s and 60s buildings that now are facing, they're replacing things. They have.
That's the point. They have much bigger right now reserve funding. That's an excellent point. They're all going through pipe replacement.
Yeah,
riser.
exactly.
Yeah. Excellent point.
Okay, here's another fun one. Amenities in the building barely moves the number. Maybe 5 cents for having a pool in the building. No change for. Go ahead.
No. The pool is expensive, but it's a one-time. It's like $40,000 a year on the budget. It's not a huge amount.
Right.
Yeah.
Heat bundled in doesn't do much. And Wi-Fi cable. For people who are moving from single-family homes into condos, like downsizers, it is a significant savings for Wi-Fi and cable because they're doing a group buy.
Oh, it's so much less expensive.
So much more affordable to be in a condo. And that's one of the things I tell my sellers. That you look at these high assessments, but by the time you take out, not just fixing your roof or fixing, plumbing or whatever, it's like, how much money do you spend on landscaping every year and buying flowers? How much, do you pay for like replacing your furnace and all, but also like the Wi-Fi and cable? That can be like a $200 a month savings to a lot of people. So,
and yeah, keep going.
All right. Well, okay. So we said it before. What drives a high assessment? Staffing, reserve health. A well-funded reserves means fewer surprises and specials, and deferred maintenance, aging elevators, facades, risers. And you know what? I don't know about you, but my clients are getting very smart about this stuff, like asking about the risers being replaced, asking, what work has been done. So kudos to you, public. You are well educated when it comes to condos. So budget about 90 cents to $1 per square foot for a month in a doorman building is bottom line.
Yeah.
And $450 a month on 1,000 square foot unit. What does that say? Oh, a doorman building costs about $450 more per square foot. Okay. Older, is it pricier? Yeah. And high dues come from staffing. Okay. That doesn't really tell us much. Sorry, folks, for wasting your time there. Okay. That's it.
So one of the things so people say to me, I want to pay $250 a month for an assessment. So I want to walk up. I want one of those little buildings that has walk up where we are the engineering staff and we are the professional management and we are the everything. Okay.
Right.
And I say to them, I totally get it. But you need to understand that you will do all repairs by special assessment when they come due, and they will be divided by 3. So you need to repair a roof. It is the cost of a roof, $20,000, $5,000, whatever the number is, divided by 3. So I counsel my buyers to pay themselves an assessment that is like reserve funding. So if you live in a walk-up, put $500 a month into a reserve fund for yourself for the upcoming special assessment, because it comes. Buildings need repairs. So you pay yourself so that when it comes, you're ready to go and not panicked or encouraging the association because you're one of 3 voters to make a poor decision about the health of the building. So, because sometimes people will say, oh, we don't need to do this because sometimes you need to put yourself into a position that you maintain the health of your investment by paying yourself an assessment so that you're ready to go when you have to do something. The nice thing about a big association is they do it for you.
Yeah. Yeah. Very good point. So let's talk about those special assessments and reviews and stuff. We have something big coming up, folks, and Kyle and I are giving you the 411. And we're still learning about this, but we wanted you to know that as of August 3rd, if you are selling a condo, you need to be aware of this. And even if you're not selling a condo, but you live in a condo or you may be buying a condo, you need to know this. And the reason is it's going to change the landscape for how quickly the loan will go through for your buyer. Right? Is that a nice way?
Yeah.
Okay. So it used to be if a building had the reputation or, a quick review, it looked good. If you were putting enough money down, they did what they called a limited review of your building. That's going to go away as of August 3rd. Every unit in every building has to go through this full review process. So when you're selling,
why do you think that happened?
It's all from Surfside.
I know because this is post Surfside that they allowed limited review. So what has happened? I don't know. It's because it did go away. I read something that the current administration blamed the past administration for something that has to do with this, but this is going to be very difficult and expensive. Back to you, Anne. I just don't know why. Yeah, go ahead.
It is for sure. Okay. So I love this line. The express lane is closing. You can't go through this. What goes on behind the scenes is your lender sends this condo questionnaire. It gets filled out. Certain questions are answered. And if it looks healthy, they go fine. Every building over 10 units now is going to get a full review. So I'm going to go through some examples here based on a sample building that has 100 units, $1.2 million in annual budget. Okay. So it's about $1,000 per month per unit in assessments. Okay.
One quick question. Is this just for FHA? I mean, for buildings to pass the FHA test?
Oh, that's a really good question.
For conventional mortgages and not balloons? Excuse me, not jumbos? I don't know what the answer is, but this is
it is going to be jumbos because they said it doesn't matter what price.
Okay.
Yeah.
Okay.
So, here are the 6 check marks. Reserves, delinquencies, how many owners are past due on their assessment bills, how much of the building is owned by only one person, the single owner cap, how much of the building has commercial space, which happens frequently here in Chicago, insurance, do they have enough insurance on the building, and critical repairs. So let's run through them quickly here. Okay. Reserves. They're going to be required to have 15% of their operating budget in reserves from 10%. So that means if you're spending $1,000 a month, you're going to have to, your fee is going to go up $50 because they have to, in this sample of a building that has $1.2 million in operating budget, that means they used to have to put $120,000 in reserves every year. Now they're going to have to put $180,000 reserves. So divide that by 100 units. That means each unit has $50 more they have to pay an assessment. Did I track on that? Follow me?
I get it. Yeah.
All right. It used to be 15 units could be behind in their payments of their assessments. Now, if there are 20 units or more,
No. So this means only the cap 15 units can be behind on. Yeah.
Right. If there's more than that, ding, you fail. The same thing. If you have more than 20 units in a building that are owned by one entity, then that building fails. For example, 34 Delaware, they have a big problem with that. Okay. And here's what sinks it overnight. And if the building has critical repairs that have to be done, they have to have 10,000 per unit in reserves. So
And
go ahead.
critical repairs are not just painting or the little things. They are risers, they are elevators, they are roof, they are
Facade
the
repairs, like if the city cites you for
facade.
having to fix your facade. Yeah.
Yes. Yeah.
Big water intrusion because it hasn't been
Yeah.
caulked properly. So,
Yeah.
$1 million actually isn't even all that much when you have a big building that needs a lot of work. But okay. So here's the deal. Ask your board when the last reserve study was done. Typically they're done every 3 to 5 years, and that says what needs to be done so you can anticipate what's coming up. Ask the building what percent of the budget goes to reserves. If it's under 15%, expect that an increase will be coming so that they can come into compliance. And then are there any big repairs not yet funded? So
number two, many buildings will give you your monthly bill, which will say operating budget and reserve funding. So you can tell just based on looking at that, because there are two ways that reserves are funded. One is direct funding. Part of the assessment goes directly into the reserves. And then there at the end of the year, if there's any cushion at the end of the year, unspent operating funds, they will deposit that at the end of the year into the reserves for the next year. So there are two ways to do it. And it's good to understand when you're purchasing, how does this building do it?
Mm-hmm.
Yeah.
Yeah. Thank you. That's exactly right.
But people, keep going. We'll come to the end. Yeah.
Well-run buildings will shine because they will breeze through this full review.
Yeah.
And so, I mean, the question is, if you have a question about what kind of building you're in or what questions you need to ask, and if you're a buyer or thinking about buying, reach out to us and we'll chat with you.
So what this doesn't mean, this doesn't mean you can't ever get a loan. It doesn't. You'll get a loan. It means that your building will be unwarrantable, which means you can't get a loan that can then be sold on the open market, securitized. That's what lenders love. They love a loan that they can then turn into a money-making thing, sell on, do all sorts of, they can do all sorts of things. But if it's unwarrantable, you will find that you have to go to a lender who does unwarrantable loans, willing to hold a portfolio of loans, and the interest rate will be higher, not hugely higher, but enough higher that you'll be like, Urgh. So you can still buy into these buildings. I know a number of buildings that are unwarrantable that do a lot of lending, get loans, a little bit harder, but get loans. There are banks that are very much into unwarrantable buildings. Citibank is an example. So it's doable to get lending, but you want to be in a building that makes it easy to get the lowest possible rate for a loan. And this is that increases the value of the units in the buildings. Buildings want to be warrantable. So this is what we're talking about. It's making it less expensive to live in that building and the units in that building more valuable.
Right. So fewer lenders will do it and they will do it at a higher rate. Let me give you an example. I was looking at a unit that I was talking to the seller about listing, and there has been a kerfuffle over a leak into a particular unit, not the unit that I'm going to be selling.
Yeah.
But this has resulted in a lawsuit to force compliance with the homeowners association. There's only one lender who does loans in the building because it is unwarrantable right now. And I was speaking with the lender, and he was telling me that if rates today are 6.5%, it's 7.5% in that building. Just give you a sense. And then the other thing is it's 2 points. So if the property is $400,000, you're looking at $8,000 just to buy. Once the lawsuit goes away, you can refinance, but here's the trouble. My potential seller here has to reflect that in a lower sales price today if they want to sell today, right? Now that is, and I remember when 1160 South Michigan Avenue was in a lawsuit with Walsh Construction over the balconies.
Mhm.
During that 2 to 3 year period, those units were selling for a lower amount of money. But the good news is, as soon as that gets done, the values go up and you can refinance conventionally with the lower rate, not a big deal. So, but now with the one I'm speaking about, where it's 2 points, 2 points and 1.5% or 1% higher, that's not typical. I mean, that's
No.
really the limit. There are other ones that are unwarrantable that don't have that much of a differential between the regular interest rates and the inflated interest rates. But
Yeah,
I just wanted,
there's certain buildings for some reason that there's only one lender who will lend to it.
yeah,
And
yeah,
I would be cautious about buying into a building in that situation. You want to have, because it suggests that everyone else is like, I'm passing. And you never want to buy into a building where people pass on, where people who've done a review or bankers who've done a review are like, ugh, no,
yeah.
no.
In this case, this is a short-term thing and it'll go away. So I think I'm going to
Yes,
have
yes,
her hold
yes.
up. But
Hopefully, yeah.
but there are lots of buildings in Chicago that are unwarrantable, that are perfectly healthy. They just have a lot of commercial space, right?
Yes,
So, so I didn't mean to make it sound like don't ever buy in an unwarrantable
no,
building, and I know you agree with me. So
agreed. All
that's it
righty.
today. I know it was a dense show today. We didn't see any pretty properties. We're gonna have to see pretty properties next week, don't you
Also pretty
think?
proud. We'll come up with
Yeah.
it.
Big weekend coming up, Old Town Art Fair, right? Is this
I'm
weekend?
gonna,
We love that.
please don't rain. It always rains. It's either rains or is broiling hot. I'd like a sunny 75-degree day. Thank you. I put
Okay.
my order in now.
But Grantport Music Festival is starting in my neighborhood too. And yes, summer in Chicago, everybody. Thank you for watching. Follow us on socials, subscribe to our channels, and call us when you need real estate help, right?
Yes. Thank
Thanks
you
for
for
watching.
watching. Bye.